All right. Good morning, everybody. Good morning, everybody, and happy Monday. Today's February 5th, 2024. New week is upon us. And, well, we're starting off pretty much same way last week went. We've got a hawkish JayPow, and we've got stocks crashing in China. And China's going to do China things. They're saying no more stock selling. Nobody's allowed to sell stock. And that's how we solve a stock market crash in China. Ta-da, magic. We just take away the sell button. And before you start casting judgment at China, let's remember, guys, here in America, we took away the buy button because the rich and powerful didn't like the stocks were going up, so they just made it so the plebs couldn't buy. Is that really any different than what China's doing right now, saying, hey, nobody's allowed to sell so that our stocks can go back up? It's kind of the same thing. But the main story was Jerome Powell last night. He was on 60 Minutes, a very widely publicized interview. He didn't say anything particularly groundbreaking. If you were watching the live stream that I did during the FOMC on Wednesday, then you didn't hear anything new. The point is, when Powell goes on 60 Minutes, that's when he's taking his FOMC message, which, let's be honest, nobody outside of us really watches that. You know, the financial system watches it, but Main Street doesn't really watch that. When he goes on 60 Minutes, he's talking directly to Main Street, and he's trying to make his case to Main Street. And again, he reiterated the same points, that they've made progress on inflation, which is true. They have made progress on inflation, and all they had to do was freeze the housing market solid and drive Americans further into debt by raising up interest rates. But that more work remains to be done. And again, he reiterated that March rate cut, as of right now, it would not be appropriate to cut in March. That rate cut is not coming in March. And the market has begun to adjust to that. We're seeing in CME futures, the odds of that March rate cut were down to about 15% this morning, which I think is in line with what Powell has been saying. But stocks are just ignoring it. Stocks are saying, silly rabbit, we only ever go higher. And, well, you know, back when the odds of a March rate cut were 80%, the S&P 500 was a few hundred points lower than it is right now. And in the last couple of weeks, the odds of that March rate cut have virtually evaporated, and yet stocks continue to march higher. Well, that doesn't really make sense. We've got a stronger dollar this morning. We've got higher interest rates this morning because of what Powell said yesterday. And the Chinese stock market's back on that one, guys. At one point yesterday, the Chinese index, the CSI 1000, was down as much as 8.7% on the day. On the day, that's what, like a 3,000 point drop in the Dow in one day is the equivalent of what the CSI 1000 did yesterday. Now, it ended up closing the day down 6%, a much more modest decline, still a huge drop. But China's stocks are just, it's a bloodbath, a bloodletting going on over there. The Chinese housing market is collapsing. The Chinese developers are collapsing. Chinese consumers feel less wealthy because their homes have stopped going up in value. And so the average Chinese consumer is spending less money because he feels poorer. That's known as the wealth effect. When homes don't go up in value, when homes drop in value, people tighten up their spending. We have seen that here during the GFC. Now China's seeing it, and that's just causing Chinese stocks to sell off across the board. And China's saying, well, nobody's allowed to sell stocks. Our problem solved. Elsewhere this morning, we've got Caterpillar earnings were out. Cat earnings were pretty good. They blew away expectations. Now, we have got higher prices for Caterpillar bulldozers and equipment. That is being partially offset by lower volume of sales. So basically, inflation driving Caterpillar earnings higher. But really what's driving it is you've got this big surge in U.S. government spending here. We are building electric vehicle factories that are subsidized. We are building chip factories that are subsidized. We are supposedly doing a lot of exploration for rare earth metals and things that we need to make electric vehicle batteries, things that right now can only be sourced in China. That is government subsidized. So Caterpillar is the beneficiary of government subsidies right now. They're raising their prices because, well, it's not even our money. Sure, we'll pay more money for a bulldozer. The taxpayers are on the hook for it. But notably is Caterpillar's dealers are cutting their inventory. And historically, that has been a big problem for Caterpillar. Not so much this morning. Caterpillar stock's having a great day. We got Estee Lauder, the cosmetics manufacturer. They are announcing layoffs, thousands of worldwide layoffs today. And the stock market is continuing in the tradition of rewarding companies that cut their workforce. Estee Lauder is cutting 3,000 jobs, and their stock is up. Another problem at Boeing this morning, the 737 MAX, they've got some holes were drilled in the wrong place for some of their fuselage segments. And it looks like that's actually a story from a couple of months ago. We talked about this on this channel when it was first discovered. But now they've done their extent of condition, and Boeing is saying that these holes being drilled in the wrong place will delay the delivery of 50 of their 737 MAX jets. That is a material event. It's another quality control issue for Boeing with the 737 MAX. The problems just keep piling up for Boeing. That stock is down this morning. And over at Goldman Sachs, one of their analysts was in danger of actually having a coherent, independent, abstract thought. And so very quickly, the company just issued Xanax to all their analysts. They came to their senses and said, nah, man, forget it. Let's just upgrade Nvidia again. Goldman Sachs upgrading their Nvidia price target to $800. Why? Because that's just a tradition. That's what we do. We upgrade Nvidia, and Nvidia stock is up another 3% this morning. It's another one of those mornings, guys. Why don't we shrink my big melon of a head and let's see what is happening in the world of stocks this morning. We have got the S&P. Oh, by the way, don't forget that like button while we're shrinking me. Don't forget that like button for the YouTube algorithm. And if you're new here, hit that subscribe button. We do this every morning. So come have your coffee with the melon heads. Right now, the S&P is down 14 points, or about 0.3% lower this morning. The Dow is down 110, also about 0.3% lower. And the NASDAQ is down 33 points, or about 0.2% lower. So stocks down across the board. NASDAQ faring a little better, no doubt being buoyed by that Nvidia upgrade. Looking over at the Dixie, we have a substantially stronger dollar this morning. The Dixie's been on a tear the last couple of days. We're now at 104.44. We got that 104 handle. We blew right through it. This is no doubt on the heels of what Jerome Powell said yesterday in that 60 Minutes interview. A less dovish Fed, or a slightly more hawkish Fed, means a stronger dollar, means higher interest rates. And so the market is having to reprice for what JayPow said yesterday, which should not have been a surprise to anybody. I guess the fact that he said it again, and he said it to Main Street, has the market saying, I guess JayPow really means business, because we've got a sharply higher dollar. That's going to put downward pressure on the price of just about every asset across the board when you get a 51 basis point move in the Dixie in one morning. And we're seeing that in the yield curve also. Yields are higher across the board, especially on the long end. Check out the long end of the yield curve, guys. The 30-year Treasury, 4.317, up another 9 basis points. This one was up big last week. Interest rates the last 2 or 3 days, they really started heading north again. The 10-year, 4.12. That was like 3.8 a few days ago. Guys, this is the world's largest, most the world's largest, most liquid market in the world is the 10-year Treasury. It's not supposed to make moves like this intraday. I don't know what is going on in the 10-year right now, but it's up another 9 basis points this morning at 4.12. The 2-year is up 6 points, 4.43. The 1 month, 5.393. That's essentially unchanged, a little bit higher though. And check out some of these moves in the 10-year, guys. I drew some of these lines a couple of days ago. You know, we rode up all throughout last fall until about Halloween. Bill Ackman announces he's covering his short, and then all of a sudden yields start falling. Everybody starts pricing in the Fed pivot. We come to about the start of the year, right around Christmas, yields started moving a little bit higher. And then, of course, last week we had a little bit of a threat of a banking crisis broke out last week, with New York Community Bank posting hundreds of millions of dollars in losses on commercial real estate and multifamily residential real estate. More to come on that topic in the next couple of days, by the way. Big drop in the 10-year yield. And then after the FOMC last week, and then again this morning, we've got a big move up on Friday, another big move today. Now, you notice this trend line that I drew that started at Christmas. We're retesting that level right now. So we'll see if we reject this level like that we broke down from last week. If we reject this level, it means 10-year heading lower. If we recapture, close above it, it means this little, whether it's a dead cat or a bear flag, whatever you want to call it, but it would mean that chart is still in play there. Looking over at commodities, we've got gold, does not like higher interest rates, does not like the stronger dollar. April gold futures at $2,031. That's down $22.45 this morning, almost 1.1% lower for gold. March silver futures at $22.38. That's down 40 cents, almost 1.8% lower. Platinum is actually about positive by about 1/3%. Palladium's down by about 1/4%. West Texas Intermediate crude oil futures for March at 72.27. That's unchanged on the morning. So precious metals not liking these higher rates and the stronger dollar. Oil unchanged. This is the story that is driving things right now. We have got Powell insists that the Fed will move carefully on rate cuts. We'll probably see fewer than expected probably fewer rate cuts, that is, than the market expects. All right. So again, no big surprises here, but it's just that he said it again. I guess the market is finally paying attention. Federal Reserve Chair Jerome Powell vowed in an interview aired Sunday that the central bank will proceed carefully with interest rate cuts this year and likely will move at a considerably slower pace than the market expects. In a wide-ranging interview on 60 Minutes after last week's FOMC meeting, Powell expressed confidence in the economy, promised he wouldn't be swayed by this year's presidential election, yeah, right, and said the pain he feared from rate hikes never really materialized. I really hope he knocked on wood before he said that. The pain that he feared from rate hikes never really materialized. Have you seen the commercial real estate sector, JayPow? Have you seen what it's doing to small banks? Before you go and say that pain never materialized, maybe you just say, we are pretending like that pain never materialized, even though every skyscraper in every city across the country is worth about half of what the owners paid for it a few years ago. And there's just no way that's not going to lead to some kind of a financial crisis. But no, the pain never materialized. With the economy strong like that, we feel like we can approach the question of when to begin to reduce interest rates carefully, he told the news magazine Scott Pelley, according to a transcript CBS released. We want to see more evidence that inflation is moving sustainably down to 2%, Powell added. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut rates. As he did during the Wednesday news conference, he said it's unlikely the FOMC will make that first move in March, which futures markets had been anticipating. And that's the key takeaway there, Guys, that's why rates are higher this morning. That's why the dollar is higher this morning, because once again, Powell reminded the market that March is off the table. March is not happening. And the market is starting to pay attention to that, at least in rate futures. This is right now the odds of a March rate hike are down to just 15.5%. That was over 80 a month ago, guys. Now it's just 15.5, almost 84.5% likelihood that there will be no action taken at the March FOMC. And now even the odds of a May rate cut, now they're much higher, but at this point, we've got even a 33% chance of no rate cut in May. So we're down to 56% chance of a 25, 10% chance of a 50% rate cut. Between the two, we've got about a 66, 67% likelihood that we actually get some cut in May. But even here, just a 33% chance of no cut in May. That is a big repricing of expectations based on just a few weeks ago. Now, shifting gears over to China, it was a busy night while we were all sleeping. All hell was breaking loose in the Chinese stock market. China stocks post more wild swings after Beijing's stability vow. Light on details, but they swear they're going to impose stability, whether you want it or not. Chinese stocks were caught in another volatile session Monday following last week's rout, as investors assess the latest pledges by policymakers to stabilize the slumping equity market. Now, check this out. This one here, the CSI 1000 gauge, frequently used as the underlying benchmark for snowball derivatives, has been facing selling pressure as the products hit so-called knock-in levels that incur losses to investors. It slumped as much as 8.7% early on Monday before closing down 6.2%. So we were down big at some point, and they ended up recovering a lot of that. I mean, they're talking a little bit here. The Hang Seng actually ended up having a halfway decent day. It was down, but it was down just barely. But check out what China is now saying here. China tightens some trading restrictions for domestic and offshore investors. Quants barred from cutting positions in leverage strategy. Cross-border swaps used to short Hong Kong stocks also curbed. Listen to some of the language here. I mean, if we just don't let people sell, I guess stocks can never go down. China is tightening trading restrictions on domestic institutional investors, as well as some offshore units, as authorities fight to stem a deepening stock rout, according to people familiar with the matter. Officials this week imposed caps on some brokerages, cross-border total return swaps with clients, limiting a channel that can be used by China investors to short Hong Kong stocks, said the people asking not to be identified. At the same time, some Chinese brokers that use the channel to buy mainland shares for their offshore units were told not to reduce their positions, the people said. And that language is pretty strong there. Like, hey, we're not banning you, but you're allowed to sell, but don't, is what the government is saying. Do not reduce your positions. Pretty strong language. And again, when the Chinese Communist Party calls you up out of the blue and says, do not reduce your positions, if you go and reduce your positions, you're going to get a visit from people you don't want to visit for. You might be sent away for re-education. You might get that phone call you never wanted. Some quantitative hedge funds, meanwhile, were barred or banned from placing sell orders completely starting on Monday, while others were barred from cutting stock positions in their leveraged market neutral funds. These bets, known as a direct market access strategy, are believed to have amplified the recent sell-off in small cap stocks, the people added. So again, guys, I mean, it's not an outright across the board ban in selling for everybody, but the government is calling up specific funds saying you're not allowed to sell. They're telling people in Hong Kong, you're not allowed to sell. They're cracking down on Chinese firms who have curbs in place where maybe they can't sell in the mainland, but they can route money through intermediaries and short stocks in Hong Kong. Well, the government is saying you can't do that anymore. Price controls. That's what this is. These are price controls on stocks. And, well, if you've been paying attention for the last 1,000 years, you know price controls don't work, ever. Price controls do not work. They just lead to shortages, market dislocations, and inevitably they make things worse. When you don't have free market price discovery, people have no idea what things are worth, and they tend to get defensive, and that will amplify sell-offs, not make them better. And check out the CSI 1000 index. Just a lot of red on this index, guys. And you notice, look at the trend line here. Here's about November, and okay, it starts to sell off. And oh my God, guys, you notice this sell-off is getting steeper as we go. This thing is not getting better every time China announces more and more curbs and more restrictions on selling. Every time they do that, selling gets worse. Why? Because price controls don't work. And I would just add this one little hilarious. You see those 3 green candles in a row there? That was 2 weeks ago or late 2 weeks ago. U.S. hedge funds buying Chinese stocks hand over fist, trying to catch a falling knife. And, well, U.S. hedge funds, how's that going for you? Congratulations. You were exit liquidity for Chinese communists. Good job, U.S. hedge funds there. That sell-off just continuing. Now, market end was down 8 and change. Big wick on the bottom of the candle. You can see it ended up closing just off its lows there. Now, the Hang Seng had a slightly better day. You've actually got a green candle. It was still down on the day, only by 0.15%. But Hong Kong stocks fared a little bit better than China yesterday. So I figured I'd mention that one. It wasn't total oblivion for Chinese stocks yesterday, but a 6% move in the index in one day. That's a big drop, guys. Shifting gears back over to the U.S., let's talk about Caterpillar. Caterpillar climbs on crushed Q4 earnings views. This is an Investor Business Daily this morning. Caterpillar, the Dow Jones earth-moving giant, posted Q4 earnings that flattened earnings estimates, though revenue was in line with estimates amid customer inventory destocking. That's a big red flag for Caterpillar. Inventory destocking is a big problem here. Cat stock jumped in early Monday stock market action and was set to begin the regular session at a record high. Most aspects of the earth-moving giant's business have been thriving amid a $1 trillion federal windfall supporting manufacturing, mining, and infrastructure projects. In other words, the Inflation Reduction Act and the CHIPS Act, that is causing the government to just dump money into the economy to build factories that, well, let's be honest, pay attention to electric vehicles. We don't need them. And, well, people are buying Caterpillars. And, well, Caterpillar is seeing that and they're saying, oh, look, the government dumped money into the economy to fight inflation ostensibly. So what are we going to do? We're going to raise prices on our bulldozers. Well, good job fighting Inflation Reduction Act, because Caterpillar saw the $1 trillion in the Inflation Reduction Act and said, we're going to raise prices for bulldozers because we know you're going to have to buy them. So the Inflation Reduction Act didn't really reduce inflation, did it? It made it worse, as any economist outside of Paul Krugman could have told you was what was going to happen. That funding has years to run, they're saying. Still, revenue growth slowed sharply in Q4 as dealers pared inventories by $900 billion. I believe that's meant to say $900 million. I think that's a misprint there. That's a lot of bulldozers if they really paired it by $900 billion. Further, Caterpillar's backlog of future orders fell by $600 million. That's after a $2.6 billion decrease in Q3. So, yeah, this government spending is causing a big surge in buying of these bulldozers. But there's some real big red flags here, guys. Future orders are falling. Their backlog is falling. Inventories are falling. That means Caterpillar dealers don't think this buying is going to keep up. Now, typically, Caterpillar stock gets a valuation haircut when the order backlog begins to fall from its peak, but this time appears to be different. Oh, my God, did they really say it? They said it. Oh, no, what are you doing? What are you doing? There, I highlighted it. But this time appears to be different. And then Morgan Freeman comes in and says, well, it turns out this time wasn't different after all. Caterpillar stock this morning, however, is up 5.9%, $18.90 in the green here, trading at 334. Is that an all-time high? That is an all-time high for Caterpillar stock. I'm sure this one is going to end well just as soon as those government subsidies dry up and people realize, oh, that's right, people don't want electric vehicles, so why are we building factories for them? Cancel the factories, cancel the bulldozer orders, the inventory keeps falling at the dealers, then Caterpillar stock corrects. But for today, up it goes. Estee Lauder, meanwhile, is getting in on the workforce reductions. Again, that big blowout jobs report, which if you didn't catch my live stream Friday afternoon, was total horse manure. Again, you got another company announcing layoffs. We had companies announcing layoffs before that wonderful jobs report. Then we had that wonderful jobs report. And then we have more companies announcing layoffs after that wonderful jobs report. It's almost like the jobs aren't really wonderful. But I digress. Estee Lauder surges on revamped plan to cut up to 5% of workforce. Estee Lauder soared after saying it's cutting as many as 3,000 positions as part of a restructuring plan to put one of the world's largest beauty companies back on track. The owner of The Ordinary and Clinique brands has a global staff of around 62,000 and said Monday that it's eliminating 3% to 5% of those jobs. As a result, Estee Lauder expects to take restructuring and other charges of between $500 million and $700 million before taxes. The job cuts are expected to yield an annual pre-tax gross benefit of between $350 and $500 million. The company said in a statement, a portion of which it expects to reinvest to drive growth. And, well, the stock market just loves layoffs. Estee Lauder company stock is up 16.5% ahead of the opening bell, trading at 156.30. That is, however, well below an all-time high for Estee Lauder. But again, the market just loves them layoffs, man. And check out Boeing. The problems just continue for Boeing. Man, it's like we just suck at making things now. Boeing finds a new problem with the 737 MAX fuselages. Misdrilled holes on Spirit Aerosystems fuselages will require work on 50 jets and could delay deliveries. Boeing is reworking 50 undelivered MAX 737 MAX jets after a supplier's employee recently found misdrilled holes on some fuselages, a new production snafu for the aircraft manufacturer. A new snafu. I love how they're like, little snafus, just a little hiccup. You know, we got panels blowing out mid-flight. We got planes falling out of the air and killing hundreds of people. You know, snafus, standard stuff. Spirit Aerosystems, which has been at the center of quality issues affecting 737, supplied the fuselages. Boeing said that the issue could delay some deliveries in the near term and that existing 737s can keep flying. You will notice here that they're saying Spirit Aerosystems has been at the center of the quality issues affecting 737s. So it seems like the Wall Street Journal is very quick to just say, oh, this isn't Boeing's fault. This is the fault of one of their suppliers, as if Boeing has no oversight or no authority whatsoever to influence the culture at their suppliers who go out of business if they lose business from Boeing. I found that a little interesting that they devote the entirety of the second paragraph to say, oh, no, not Boeing's fault. This was all on Spirit Aerosystems. Well, Boeing down another 2.5% this morning, trading at $204, down another $5. Problems just keep piling up for Boeing, guys. I don't know how else to put it here. And again, Goldman Sachs, they were having a boring day. It was like feeling cute, might as well upgrade Nvidia, I guess. That seems to be the fashionable thing to do on Wall Street. Goldman Sachs no longer sees Nvidia's data center revenue declining later this year and adds the stock to its conviction list. Another week begins with Nvidia's now customary stock price upgrades and endorsements. Don't you just love that sentence? Customary stock price upgrades and endorsements. I'm sure when the dust settles from the AI mania, we're not going to look back at articles that begin like that and say, if only there were some indicators that this stock might have been in a bubble. When we start articles by saying the now customary stock price upgrades and endorsements, it's almost like these analysts aren't capable of thinking for themselves. They're just in this big circular formation where they're all supporting each other's upgrades. Nobody wants to be the first one to step out of the circle and say, maybe we should think twice about this stock that only ever seems to go up in perpetuity. You know what? Just upgrade it. While Stanley Druckenmiller, the chairman and CEO of Duquesne Family Office, provided Nvidia's first notable endorsement of the week, Goldman Sachs now appears to have picked up on the proverbial bullish torch. Again, if only there were some indicators it was a bubble. Picked up on the proverbial bullish torch by adding the high-flying GPU manufacturer to its conviction list. Goldman Sachs has now announced in a new investment note that it no longer sees Nvidia's data center revenue declining in the second half of this year, even though AMD just told us they see flat revenue growth in the next quarter, and AMD makes pretty much the same thing Nvidia makes. Rather, the Wall Street behemoth now models consistent growth through the first half of year 25, driven by continued spending on generative AI infrastructure by the large cloud service providers, many of whom are just taking NVIDIA's own money and handing it right back to NVIDIA, a broadening customer profile, and multiple new product cycles. So, yeah, happy Monday, NVIDIA upgrade. And NVIDIA stock is up 3.2% ahead of the opening bell, now trading at $682.80 with a $1.64 trillion market cap. What's the worst thing that could happen? Don't answer that. So we got that going on this morning. That's fun. And I just want to say thank you so much to Nashville Pasta Man, who says, had dinner with a guy from New York City. He said commercial real estate isn't so bad. Buildings are only going to lose 40% at what they're valued. That's his it's not so bad scenario. Pasta Man, I share your sentiment and your disbelief. It's not so bad. We're only looking at a 40% haircut. That's worse than what residential real estate did in the GFC. And that is their only 40% base case. And I would add, guys, like I did that 1740 Broadway building not too long ago. That building was down 71% from its 2011 value. So thank you for this anecdata, Nashville Pasta Man. And I would challenge that only 40% number because commercial real estate is starting to show up in the banks. New York Community Bank got crushed by commercial real estate last week. Now, that was a combination of office and multifamily residential, in particular, rent-controlled multifamily residential. And I'm working on a story with that it will just have you shaking your head when you see what they're doing with rent-controlled multifamily in New York and the FDIC. But only 40%, like that's a good thing, like base case. Hey, it's a $3 trillion industry and it's only going to go down by 40%, 0.4 times 3. Hey, that's only $1.2 trillion going up in smoke. And by the way, that was the number that, what the guy's name from Starwood, the CEO, Barry Sternlicht, gave in an interview last week. His base case was 40%, all right? That's a guy who has a vested interest in that being the better end of the spectrum, right? When a guy says, oh, don't worry, we only expect 40% losses, just like that guy in The Big Short saying, yeah, we expect non-subprime defaults to stay below 5%. No, it's not going to do that. All right, these buildings are already falling by 70, in some cases 80, 85%. 40 is your best case. 40, that's like if you're a prime building in a prime location in a big city, if you're lucky, you get a 40% haircut. Everybody else is seeing much bigger. And again, guys, all these buildings, this is not just some rich real estate investment company that's losing money, because those guys can walk away from their bad investments and not lose any money. The real risk here is to small banks and to retirement accounts, CMBSs, because all of this garbage debt is lurking. It's what's backing your bank deposits, or it's what's backing your retirement accounts. It's not Barry Sternlicht. It's not Steve Schwartzman at Blackstone that are going to take the hit here. It's you. And everybody's like, we have no idea where this stuff is hiding. We have no idea where it's lurking. Says the people who sold it to you. They know exactly where it's lurking. They're just worried about pitchforks and torches. And so they're trying to position themselves to be like, Oh, we care so much. We feel your pain acutely. We acutely feel your pain. We had no way of knowing this was happening. And let me just wipe away my tears with $1 million bills. And oh, here's a check for a few $1 billion. Let me wipe away my genuine tears at the thought of your pain. Trust me, these guys know exactly where that stuff is lurking. It is lurking on your books. They just don't care. They can walk away and stick you with the bill. And that's exactly what they're doing all across the economy right now. And we're just extending and pretending, and we're acting like it's not going to blow up in our faces. Well, New York Community Bank almost blew up the banking system again last week. We'll watch regional banks this week and see what they do. Thank you very much, Nashville Pasta Man, for the super chat, the support of the channel, sir. And thank you to Mr. Steve Hoytis, who says, good thing Boeing made their DIE targets instead of hiring based on skills, knowledge, and abilities. Note sarcasm. Look, I'm going to get my channel in trouble if I weigh in on that. All I'm saying is if you're in a plane and your life depends on it, I think you want to make sure the best person for the job, the most qualified individual, tighten the bolts on the plane, designed the plane, built the plane, is flying the plane. And I think I'm going to end it right there before I get myself in trouble and the outrage police shows up in the comments. And if you guys do, I just want to say you guys are adorable and thank you for the engagement. All right, everybody, that's all I got today. Thanks again, Steve, for the super chat. Thank you, everybody, for having your coffee with the Melonheads this morning. New week is upon us. Let's see where we go this week. Thank you to my Patreon supporters for everything you guys do for the channel. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.